Alright, so this year in the stock market has been pretty intense from especially this pandemic that's been going on this year. The stock market since March has been super volatile. We've had these days where prices have gone down X amount of percent and the next day they go back up. And if you're an investor like myself, then hopefully you've done your research, gained intelligence throughout the year, as I sure as hell had, and you found these opportunities to invest within the stock market. But now even leading to election day, which is today, by the way, for me, it's Tuesday morning, there's still a lot of volatility to come, I'm sure. So in this video, by the end of it, hopefully I can give you guys an idea of if you should continue to invest in stocks and ETFs as you have been, or if you should look into investing in bonds. Or when's the best time to invest in bonds? So let's find out. What is up, guys? My name is Darren Jackson. Welcome back to the channel. And we are approaching election day. At some point, again, for me, it's Tuesday, but at some point we will know who will be the next president of the United States. But this isn't a political video. This is a video pretty much just detailing the volatility that the stock market can have. And I've learned that as we get closer to election and saying that uncertainty within who will be president increases, then that typically increases the volatility because we have no idea which president will win, let alone what they'll bring to the table that will affect our economy. But volatility can happen for a plethora of other reasons. And with that in mind, I had to do a lot of thinking. What is the most preferred type of thing to invest in when it comes to the stock market? Because at the end of the day, we want to put money in hopes to get more money back out. And that's where I was introduced to bonds. So in this video, we're gonna go over what exactly is a bond for those of you guys that don't know. We're gonna go over why companies actually prefer to issue bonds out to investors rather than stocks. And then at the end of it all, we're gonna hopefully answer the question on which one is better during times like this volatility, or maybe just even for you and where you are with life. So the easiest way I can describe what a bond actually is, it's basically money that you let a company or a corporation borrow. So you let them borrow the funds and they essentially give you back an IOU. And that IOU entails, hey, by this certain period of time, which we'll call the maturity date, we'll give you that money back. But between now and then, we'll also promise to pay you a certain amount of money, which is equal to a percentage of what that face value of that bond is, which we'll call the interest rate. So let's say, for example, you buy a bond from company X worth $1,000 and the maturity date is 10 years later. So by that 10-year mark, that company will not only pay you back that $1,000, but they'll also give you, 4% back in interest. So once that 10 years hits, you get the money that you've accrued from the interest from that bond at face value and the face value of that back. And in the meantime, that company uses that money in hopes to raise money to do certain things, to expand their company, and they'll even use the money that they've raised to create more bonds and do this all over again with other investors. It's pretty similar to stocks in the matters that you're buying it towards a specific company in hopes that ultimately by the end of the day you get funds back, and with the addition of interest it works similar to as dividends, that you'll get additional money back. But what's different is that instead of giving the money to a corporation or a company to borrow, you're actually giving them a certain amount of money in exchange for partial ownership of that company, which gives you a bunch of benefits, including voting rights. Your gains increase as their gains increase, and you could potentially make some additional gains, which this part isn't different, but you could potentially make some additional gains such as dividends. Now, while I was doing some research over bonds, I actually learned a lot of reasons why companies may prefer to give out bonds to investors versus stocks. Now, the first reason is that it's cheaper. Not necessarily the face value, even though at times the face value can be cheaper, it just depends. It's more so the interest. Now with the interest, whenever you purchase that bond and you sign that agreement between yourself and the corporation, the interest that you get is a set amount. It doesn't change from when you first purchase it until the very end. So that's less money that that company is going to lose. And normally interest rates are a bit lower than in the stock market. You could find potential stocks that have higher interest rates in comparison to most bonds. Right now, AT&T currently has about a 7% dividend yield, which is equivalent to the interest rate. And I'm not sure if you're gonna find interest rates in bonds are gonna be equivalent to that. So this gives corporations opportunity to save money because they can use those borrowed funds to build up their corporation while not having to pay as much back as far in comparison to another company that will pay more in dividends. The second reason, which may seem minor, but in hindsight it's not, is the lack of voting rights. So as I've said before, when you purchase a share of stock, especially if it's a Class A stock, I believe, you also get the opportunity to vote for certain things when it comes to that company, from the executive office, maybe even the type of products that they come out with. Basically, whenever something major is prepping to change within that company, you will have the opportunity to vote for or against that option. And that vote that you have, the strength of it is based on how many shares of stock that you have within that company. That's why you see executives that own 10, 20% of a certain company have more voice in regards to what is going to happen with that company. That's why they're a part of the round table when voting is actually occurring. They can actually vocally, right then and there, say what they want. Whereas us, we fill out polls. But again, your voice is stronger typically when you own more shares. Now, when it comes to a bond, they are allowed to raise money from the funds that we invest into them as borrowed funds while not having to relinquish necessarily any power from the company. So when you invest money in bonds, you are not gaining any benefits in the form of voting rights because you're not gaining any ownership of the company. These are all borrowed funds. So it allows the corporation to continue to mold the company as they see and do whatever they want with the company. Hopefully it leads to better things. But the point is, corporations know that investors cannot affect anything that has to do with corporations and companies making decisions based off the company itself. Now, the third reason is pretty interesting. Now, a couple of videos ago, I talked about how Apple and Tesla had their stock splits, which pretty much said if you own X amount of shares of our stock, then each share will convert into X amount of shares. And when you do a stock split, no matter what the reason behind it is, it will dilute the amount that each share is. So if you have one share of a company worth $100 and they do a stock split of 4-to-1, then that means each share that you will now have will be $25 a share. Now, that doesn't happen with bonds. Companies can make profits off the borrowed money that they get from investors like you and me that invest in their bonds. They can use that money when enough is made to create new bonds, to have new investors come in with new interest perks and lend more money for the company to borrow. So with that being said, even if the amount of bonds that the company offers to a worldwide amount of investors goes up, the price of it doesn't change. So the amount that your face value is for your bond doesn't get diluted when more bonds are made. And the fourth reason companies may want to issue bonds over stocks is that bonds don't necessarily fluctuate as often. And fluctuation can happen primarily based off the supply and demand of a company's stocks, for example. And keep that in mind, we'll get back to that later. So those are some of the reasons why companies may rather issue bonds than stocks. And if you're thinking about investing in some bonds to add to your stock portfolio, then that's perfect, because there are actually studies that show that having a diverse portfolio that includes bonds could benefit you in the long run. As a matter of fact, you can actually use your age in a couple of methods to determine how much money you should have put towards bonds. So for example, method 1 says if you take 120 and subtract it by your current age, then that remaining amount is a percentage that you should be investing in stocks, and the remaining you should be invested in bonds. So for example, I'm 28 years old, so that means 92% of the funds that I have in my portfolio should go to stocks and 8% should go to bonds. If you want to be a little more aggressive with your savings, then you would just take your age and say this is the percentage. So for me, it'd be 28% I would invest in bonds and the rest towards stocks. But before you go into deciding if you should do that, what we finally need to go over is what's better to invest in. The volatility that the stock market has had throughout this year prior to the election because of the pandemic and leading to the election is the primary reason why I wanted to make this video in the first place. And before there was a reason why I wanted to look into bonds, because I heard that bonds were safer to invest in than stocks. And that actually comes true when it comes to volatility. Again, volatility doesn't really impact bonds. You purchase a bond at a certain value, the interest stays the same, and all you're doing is waiting until what you have meets the face value at the maturity date and you get your interest. So whatever the stock market does based off external situations doesn't impact the face value of bonds, which is beneficial because then you're essentially promising yourself a specific streamline of income from the interest in those bonds that you're investing in from those companies. Another reason you may want to invest in bonds has a lot to do with your age and the amount of money you want to put in. Since bonds tend to be a lot less riskier than stocks, then it's more beneficial to invest in a bond if you're a lot younger, let's say 18 years old, and you somehow have a lot of money, let's just say $1 million to invest in bonds. It's more beneficial because it's less risky. The chances of your returns being less than what they were is pretty much zero. And if you're investing $1 million in 2 sets of bonds that will promise to pay you back 4% interest until that maturity date hits, then that's essentially saying that every year you're getting back $40,000. And if you can live on $40,000, then that streamline of income can last you a long time. Now, most importantly, probably most importantly, bonds are more beneficial during a recession. As I've said before, when you purchase a bond, you're purchasing at a specific interest rate. Now, when a recession happens, that means the economy is slowly getting worse than what it was. Not a lot of people are putting money into the economy because they're not going shopping or doing other things. And one thing that can happen is that the interest rate will drop. So when the interest rate for the rest of us goes down to 2 to 1 to 0%, you're still holding onto a bond that's at a 4% interest rate. That actually gives you the opportunity to sell it early, because remember, the face value of a bond and the interest rate are inversely related, similar to a stock and the dividend yield. The higher the stock price, the lower the dividend yield, and inversely, the higher the dividend yield, typically the lower the stock price. So that works the same way as it does with bonds. So if the interest rate goes down, then you're going to want to sell that bond at a lower interest rate, which would then mean you're selling it at a higher face value than you did when you bought it. So that's beneficial as well. Now, speaking of recessions, that's been kind of the theme caused by this pandemic. Just based off the unknowns of it, people have been more afraid to go out. Being more afraid to go out results in less money going into businesses, resulting in those businesses closing, resulting in the economy going down. So what I actually learned earlier this year, yes, I'm still learning things, but I don't know everything, is that typically when we undergo a recession, one of the things that saves us is reducing the interest. You guys remember those CNBC posts back in March that was saying that the treasury checks were going down to an interest of about less than 1 to almost 0%? Well, the Federal Reserve has all control of that. And this is why they do that. So whenever the Federal Reserve reduces the interest rate of the United States Treasury, it makes it easier for people to borrow money for any type of loan, specifically for a car, a mortgage, school, anything like that. So when you make it easier, it makes people more willing and more people more qualified to do that, which puts more money back into the economy, which should help us re-stimulate it. And as I've said before, the interest rate in a treasury note, which is also a type of bond, works inversely. So whenever the Federal Reserve decreases the interest off a treasury check by buying more treasury checks, then the amount, the face value of that check goes up. So that's similar to a stock. Whenever the dividend yield goes lower, that essentially means that the face value or the price of that stock of a company goes higher. And that typically happens by demand. Same as if the Federal Reserve is purchasing a lot of bonds. So whenever you have that go up as face value, then that would make that less attractive to investors like you and me, because we don't want to buy a bond that's worth more and pays us less. So where are we going to turn to for those capital gains and periodic returns? We're going to turn to stocks. So instead of investing in bonds, we're going to put more of our money into stocks, which will help make the demand of those companies higher, which therefore increases the stocks, which therefore puts money back into their pockets, which will hopefully help in re-stimulating the economy. So in all hindsight, if you haven't invested in a bond yet, by the time a recession happens, you may want to go towards stocks, because bonds are just going to be a little less attractive at that point. So also, because of your age and the amount of money you have to invest, it's probably better to invest a smaller amount of money, if that's what you have, into the stock market. And if you're a little bit older, invested into the stock market, maybe even no matter how much it is, because there's more risk into it. And with more risk equals more reward. You have more opportunities to make more money back in capital gains and more opportunities to make more in dividends or any type of return that you may have, which was primarily dividends in comparison to bonds. And that higher return opportunity is the final reason why you may want to invest in stocks over bonds. So all in all, just from what I've learned, it seems like it's beneficial to invest in bonds when the stock market starts to become volatile and when we're leading into a recession before there's any announcement of the interest rate dropping, because you want to be locked into a position to where you're gaining more money in comparison to other people post-recession. At this point, it seems like it's better to invest in stocks, especially during this period of time that we're at during an election, and with everything else that's happened that's been the icing on the cake, for lack of better phrases. on top of all this other volatility. So that's what I plan on doing, but I'm definitely going to look into more bonds as the future goes on, because there's a lot I have planned in my life. I want to buy a house, I want to do things like that. So if I have the opportunity to take a lot of money and lock it away for X amount of years, and it hopefully grows over time while everything else in life changes, maybe even for the worse, and I can keep my money in a positive safe, then I'm going to do that. But we'll just have to see what happens. So hopefully you guys learned a bit from that video. Definitely leave your comments below if you have any opinions, any corrections that you have for me that I need to make. And make sure you guys check out some of these other videos that hopefully help you guys in your investing journey as they have in mine. Thank you so much for watching, and until next time, take care.